This is question number 3 of homework 4 for session 4. So Perkins Incorporation is considering an investment of $371,000 in an asset with an economic life of 5 years. The firm estimates that the nominal annual cash revenues and expenses at the end of the first year will be $51,000 and $76,000 respectively. Both revenues and expenses will grow thereafter at the annual inflation rate of 2%. The company will use the straight-line method to depreciate its asset to zero over 5 years. The salvage value of the asset is estimated to be $51,000 in nominal terms. At that time, the one-time net working capital investment of $13,000 is required immediately and will be recovered at the end of the project. The tax rate is 21%. So it's asking what is the project's total nominal cash flow from assets for each year, starting from the current year, year 0. So the first step to solve any question, especially the capital budgeting question, is to put the numbers into the right place. And typically, I recommend using Excel for the calculations, because that, as you will probably also see, that it's going to be very convenient in terms of both to expedite the calculations and also in terms of meeting this rounding requirement. You read the rounding requirement, it says do not round intermediate calculations and round your answers to the nearest whole dollar. Especially for the first part, do not round intermediate calculations. So if you use Excel, that can automatically meet this requirement. If you use calculators, sometimes you may need to keep the intermediate results in some piece of paper. In order to do that, you have to keep a certain number of decimal places. So in doing that, you're actually violating this rounding requirement. But Excel doesn't have such an issue because it automatically keeps all those calculations for you. So first is put the numbers into the right place in the worksheet. So I'm going to open this. First, I put a number, the year number. So this is 1, and I don't want this to be in percentage. So just change the format, put in the regular number format. And this is 1, and now I can extend this to the other years. Remember, we have 5 years, so the last year is 5. And the first number I want to put down, and remember, this is also this is the investment, and this occurs at current time point, which is 371,000. And the second number is actually the 5 years. I already put 5 years for the project life. So the firm estimates that the nominal annual cash revenues and expenses at the end of the first year will be, so the next item should be revenue and expense. So the first year's number is given. For the revenue is 251,000, and for the expense it's 676,000. And it's also provided that both revenues and expenses will grow thereafter at the annual inflation rate of 2%. So let me just put it inflation rate, or you can also put it as growth rate. Growth rate of both revenues and expense, so that's going to be 2%. And that can be used to calculate the subsequent revenue expenses for all these future years. So for year 2, for the revenue, it's going to be year 1's revenue times 1 plus the inflation rate. So here I want to fix the sale value for the inflation rate or the growth rate here, because I want to drag the sale to the other years. So Excel can automatically calculate this for me, and that's another reason for me to recommend using Excel for all these calculations, because once you have the correct formula for 1 year's number, you can easily extend that to all other years. and Excel will automatically calculate the numbers for you. So now I have this, and I can drag the cell all the way to the last year, and you can see that, for example, for year 3, it's going to be year 2's revenue, which is D3, and then times 1 plus this B dollar 5, which is the growth rate, 2% here. And that's exactly what I want. And also, as I said, Excel automatically keep these numbers, even though it only shows one decimal place, but actually that's only for display purpose. What Excel has in its system is still a more precise number for all these values. And we can do the similar thing for the expense. Year 2's expense will be year 1's expense times 1 plus this growth rate. Again, I want to fix the cell value for the growth rate because I want to extend this to all other years. So now I'm done with this part of the input from the setup. The company will use the straight line method to depreciate its asset to 0 over 5 years. So this gives me the annual depreciation expense, which is the initial investment divided by 5. But I do want to fix the sale value for the initial investment for the same reason, because I want to extend this to all other years. So Excel will automatically calculate the annual depreciation for me. So that's the depreciation expense. The salvage value of the asset is $51,000 in nominal terms. So the salvage value here means the selling price of the remaining asset. So that occurs by the end of the project. So the salvage value will be at year 5. So just put that number here. But remember, we need to pay taxes on the salvage value. And what's the tax base? Tax base will be the salvage value, which is the before tax selling price of the remaining asset, and the remaining book value of the asset, or the book value of the investment, right? Initial investment, to be consistent with the term I used earlier. So that's the formula for the tax base. So now what is the salvage value is given here. So what is the remaining book value of the initial investment? The setup already told us that the investment will the company will use the straight line method to depreciate its asset to 0 over 5 years. So that already told us that the remaining book value of the initial investment will be 0 by the end of the project life. So that means the tax base will simply be the salvage value. Salvage value minus 0, that's simply the salvage value. And then the taxes will be based on the tax base, right? Tax base is basically how the taxes will be levied based on. So that's going to be this tax base multiplied by the tax rate. So the tax rate here is provided to be 21%. Just multiply by that. And now I can calculate after-tax salvage value, which is simply the before tax salvage value, which is the salvage value of 51,000 and minus the taxes. So, and then continue this setup. The one-time net working capital investment of $13,000 is required immediately. So the NWC is 13,000 is required immediately. So that's current time point 0, and will be recovered at the end of the project. So that means by the end of the project, it's going to be 0. But in between, it's going to be the same as the starting level. So from that, we can calculate the incremental NWC, which is what we need in order to estimate the free cash flow. So for the starting year, there's no prior year, so the change in WC is the same as the level. But starting from year 1, it's going to be year 1's that particular year's level of the NWC minus the previous year's NWC. So then I can extend this to all other years, and now I have the change in NWC for all these years. So basically, I have put all the numbers given by the setup into the worksheet, and I can now start the calculation of the free cash flows. So the starting point is to calculate the operating cash flow. In order to do the operating cash flow, because operating cash flow is EBIT, we start from EBIT and then we add back the depreciation and then we deduct the taxes, right? So in order for that, in order to calculate this, I do need to calculate first EBIT, right? EBIT, basically I need to add a just to add a row here. So this is my EBIT. EBIT is what? Revenue minus expense and minus depreciation. That's my EBIT, right? So now I can just put the numbers into that formula, minus revenue minus expense and minus the depreciation. And then extend that to all other years. And then I need to add another row here for the taxes, right? Taxes will be based on the EBIT. Normally, EBIT means that actually the EBIT means that earnings before interest and taxes, right? So normally we need to deduct the interest from EBIT to arrive at EBT, which is earnings before taxes, and then taxes will be based on EBT. But in capital budgeting, actually, we incorporate the impact of the interest expense not into the cash flow estimation, but into the discount rate estimation. So that means if we want to estimate the cash flows, we actually ignore the effect of the I part of this EBIT. So that means EBIT actually becomes my EBT. So the taxes will be based on EBIT times the tax rate. So that's going to be this, and then 21% times 21%, and then extend that all other years. So now I have everything ready in order to calculate this OCF, operating cash flow. So it's going to be EBIT and plus the depreciation, and then minus the taxes. And then extend that to all other years. But we are not done yet, right? Because this is just the operating cash flow. What we eventually need is the free cash flow. A free cash flow is equals what? OCF. And then we need to do two adjustments. One is the minus the investment, right? And then minus the change in NWC. Actually, the change in NWC is sort of a short-term investment. And investment here stands for the long-term investment. It's like this initial investment. It can be depreciated over multiple years. So that's long-term investment. And we also need to do another adjustment, which is to add back the after-tax salvage value. So that's the formula to get the free cash flow. Now with that, we can calculate this free cash flow. We start now compared with OCF, which we start from year one, because the company is not expected to generate any operating cash flows until year one. But free cash flow, we actually start from now. So it's going to be OCF on, remember here, even though this sale value here is empty, but still I need to put that the sale into the formula, because later on I want to drag this sale to all other years in order for Excel to automatically calculate the free cash flow for all other years. So this is OCF, and then minus the initial investment, it's right here, and then minus the change in NWC, and then plus the after-tax salvage value, which is right here. But again, even though this sale value here is empty, but I still need to put the sale into the formula. So that's the free cash flow for the first year, and then extend the same formula to all other years, and Excel will automatically calculate this free cash flow for all other years. And then going back to the Rounding requirement, it asks us to round your answers to the nearest whole dollar. So I'm gonna follow that and format the cells and just keep the numbers to keep 0 decimal place. And then the rest of the job is simply to put the numbers back to the to connect. So I have done inputting all those answers back to its connect. Actually, you can see that I also followed the rounding requirement by putting a negative answer, negative sign in front of the negative cash flows. So now it's time to check my work. So that's correct.